I think public market investors have it wrong for the most part because they're looking backwards, as I mentioned before. I think private equity or venture capital investors have it more right because they're looking out. They're looking to the future and they're looking long term. So our investment time horizon is 5 years, and we do that for public companies. Most investors are looking at 1 year. Well, if you take a look at the difference between linear growth and exponential growth over 5 years, it's night and day. The numbers will be very, very different. Whereas most investors are just looking at this year, and the base level, if you're comparing an emerging trend to a well-established trend, you're going to probably be much more comfortable with the established trend because you're not looking far enough to see the explosive growth trajectories. And it is interesting, even within the private markets, yes, we're seeing significant corrections in some companies' valuations, but not in the truly differentiated, highly differentiated. Sure, some of a correction, but in the public markets, we have seen 80% declines in companies. It's been shocking. I've never seen anything like it, and it makes no sense. So I think that the valuations in the private markets are more in keeping with what we think is going to happen long term. The average Japanese investor, retail investor, is older, 50s, 60s, 70s, 80s. They live a long time there. And they are very conservatively positioned in cash and bonds and conservative stocks, maybe high yield, dividend yielding stocks. That's about 95% of their portfolios. But then for the other 5%, they tend to swing for the fences. And they are very thematic. They love technology. In fact, most people do. I find it surprising that we believe that the Japanese DNA in terms of investing is very much like ours, certainly for that 5%. But their appetite for technology and also the way their educational system has been set up. If we look at some of the biggest breakthrough in genomics, Professor Yamanaka at Kyoto University, pluripotent stem cells, discovered them. I mean, that's a huge breakthrough. Cloud computing, they were some of the first to embrace because they're resource constrained in terms of energy. They're big into energy efficiency, battery technology, and likewise because they have an older demographic. The population is aging very quickly. They've been the first to embrace robotics in a very profound way. So, they're inherently drawn to innovation to solve some of their problems. And that's why they love what we do. Our clients want to understand how much we understand about the backdrop we're facing. And so, yes, we believe we're in a recession. 2 consecutive negative quarters of real GDP growth is one. 3 consecutive months of leading indicator declines is another indicator. Employment, I know everyone's focused on that. Non-farm payroll employment, very strong, surprisingly strong, but it is always a lagging indicator compared to the household survey of employment. So going household by household instead of company by company, because that captures more small businesses. Those employment numbers are negative on average over the last 4 months. So we think we're in a recession, but what does that do to our research? Nothing. What does innovation do? Innovation solves problems. And starting with COVID, major problems. And the genomic revolution, big part of helping us get over that problem to the extent we have. And then on top of that, supply chain issues. And then the war in Ukraine. All of those are problems. And now we have a recession on top of that. Innovation solves problems, and so it gains more traction during tough times. And so what we do is double down on our research and assume that some of our trends are going to be turbocharged here. As the global digitalization of work and life generally has been, as the search for a vaccine has been, now with energy and food prices skyrocketing, even more important to move towards a substitution for oil and to use the genomic revolution to create better yielding crops in less fertile areas than the Ukraine. So if anything, it increases our confidence in the innovation, the 5 platforms around which we have built our research. I think a lot of people have been surprised at how badly Bitcoin has done in this environment. But what has happened, especially since we first started doing our research, a lot more investors have become involved with it, traditional and hedge fund investors. And so in a risk-off environment, which is what inflation and higher interest rates has meant over the last year and a half, in a risk-off environment, Bitcoin, especially this year, has succumbed to the significant deterioration in most asset classes. I mean, this is the worst bond market, believe it or not, since 1788, more than 200 years ago. We've never been in this bad a bond market, certainly through the first half of the year. The stock market, worst through the first half since 1970. And Bitcoin was doing well until last November. It almost hit 70,000. Now it's down to the low 20s. And yes, our confidence has increased, believe it or not, in our price target. One of the reasons is the partnership between BlackRock and Coinbase. We're seeing the traditional investment firms really being pulled by their clients into supporting or providing an infrastructure for institutional investing in the space. And by our estimates alone, if institutional investors put 2.5% into Bitcoin, that would more than double the price right now. We think that that's just one use case, though. If you look at emerging markets, which are being terrorized by inflation right now, talk about collapsing purchasing power. While 70,000 to the low 20s is a very big correction, what it does not change is the fact that Bitcoin is mathematically metered to top out at 21 million units. And if you look at most of the supply, we're at 18.5 million units, I think, are out there right now at Bitcoin. 14 million of those are illiquid. People hold on to Bitcoin. So if we now have this institutional investor base moving more aggressively into Bitcoin, at the margin, the supply relative to demand, there's I think only 3 million in liquid supply. At the margin, I think it could drive the price up much more than the doubling I've said, just because of that imbalance. So our confidence has increased in that forecast for 2030.